My dear students of the market, throughout my career I've emphasized what I consider the single most important concept in all of investing, the margin of safety. Yet I observe that most investors fundamentally misunderstand this principle. They treat it as a mere mathematical calculation, buying a dollar's worth of assets for 50 cents. But the true margin of safety is far more profound. It's primarily a psychological buffer against the inevitable limitations of human judgment. Let me be perfectly clear. The margin of safety isn't about being right. It's about surviving being wrong. This distinction separates the professional from the amateur, the durable investor from the transient speculator. Consider this reality. No matter how thorough your analysis, how deep your research, or how brilliant your insights, you will be wrong about investments more often than you anticipate. The margin of safety exists not to prevent errors, but to ensure those errors don't prove fatal to your capital. I developed this concept during the Great Depression, not as an academic exercise, but as a survival mechanism. We weren't trying to maximize returns. We were trying to avoid permanent loss of capital. This mindset shift, from seeking gains to avoiding devastating losses, forms the foundation of intelligent investing. The psychological aspect begins with what I call the humility calculation. Before purchasing any investment, you must acknowledge three fundamental uncertainties. You might be wrong about the business's prospects. You might be wrong about its value, and external factors beyond your foresight might emerge. The margin of safety protects against all three. Modern investors face a particular challenge here. In an era of infinite information and analytical tools, there's a dangerous illusion of precision. You can calculate discounted cash flows to the decimal, analyze every ratio, model countless scenarios, and still be completely wrong. The margin of safety reminds us that investing is not a science of precision, but a discipline of probabilities. Let me share a principle I've observed across market cycles. The stronger your conviction about an investment, the larger margin of safety you typically require. This seems counterintuitive to most investors, who tend to reduce their safety margins when they feel most confident. But this is precisely when you're most vulnerable to cognitive errors. The psychological dynamic at play is what behavioral researchers now call confirmation bias, the tendency to seek information that confirms our beliefs and ignore contradictory evidence. When you're deeply convinced about an investment's merits, you naturally underestimate risks and overestimate your knowledge. The margin of safety acts as an automatic correction to this tendency. Now, let's discuss practical implementation. How does one actually build psychological margin of safety into their investment process? It begins with what I term the three-layer protection system. The first layer is the traditional financial margin, buying assets significantly below your conservative estimate of intrinsic value. This is the mathematical foundation, but it's only the beginning. The second layer is qualitative margin, investing in businesses with such fundamental strengths that they can withstand management mistakes, competitive threats, and economic downturns. These are companies with durable competitive advantages, strong balance sheets, and reliable cash flows. The third layer, and most overlooked, is psychological margin, structuring your portfolio and process to withstand your own emotional vulnerabilities. This includes position sizing that allows you to sleep peacefully, diversification that prevents catastrophic loss, and processes that control impulsive behavior. The modern investor's challenge with psychological margin is particularly acute given the constant market noise and pressure to perform. I see investors checking prices dozens of times daily, reacting to every news fragment, and making decisions based on short-term performance pressures. This environment systematically erodes psychological margin of safety. Here's a practical exercise I recommend. Before making any investment, write down the specific conditions under which you would sell. Not just price targets, but fundamental changes that would cause you to reconsider your thesis. This creates psychological space between market fluctuations and your decision making. Another crucial element is what I call time margin. Most investors operate with dangerously compressed time horizons, feeling pressure to see results within quarters or even months. The true margin of safety investor thinks in years, sometimes decades. This extended time frame provides psychological breathing room that short-term speculators never experience. Let me illustrate with a personal example. In the aftermath of the 1929 crash, I purchased certain bonds that appeared deeply undervalued by any reasonable measure. Yet the market continued to decline, and these bonds became even cheaper. Because I had built adequate margin of safety, both financial and psychological, I could withstand this temporary discomfort without panicking. Investors without this margin were forced to sell at the worst possible time. The psychological benefit here is what modern researchers term decision pre-commitment. By establishing your criteria in advance, during moments of calm reflection, you protect yourself from emotional decision-making during market storms. This is margin of safety applied to your own psychology. Now, I want to address a common misunderstanding. Margin of safety is not about avoiding risk. All investing involves risk. Margin of safety is about ensuring you're adequately compensated for the risks you're taking. It's the difference between intelligent risk-taking and recklessness. This leads me to a critical distinction, the difference between probability and consequence. Most investors focus exclusively on the probability of being right. The margin of safety investor focuses equally on the consequences of being wrong. You can be right about 9 investments out of 10, but if the 10th wipes out your capital, your process is fundamentally flawed. The psychological shift here is profound. Instead of asking, how likely am I to be right, ask, what happens if I'm wrong? This single question transforms your investment approach from speculation to intelligent risk management. In our next discussion, I'll share specific techniques for calculating margin of safety in modern markets, including how to adjust for different asset classes, market conditions, and your personal risk tolerance. We'll explore case studies where margin of safety protected investors and where its absence proved catastrophic. Remember, the market doesn't care about your confidence, your analysis, or your track record. It will test your judgment repeatedly. Margin of safety is what allows you to survive these tests and continue playing the game. Without it, you're not investing. You're speculating with your financial future at stake. The beautiful truth about margin of safety is that it provides its greatest protection precisely when you need it most, during market crises, emotional turmoil, and periods of extreme uncertainty. It's the anchor that keeps your portfolio and your psychology secure during storms that sink less prepared investors. Now that we understand the psychological foundation of margin of safety, let's explore its practical application in today's complex markets. Many investors ask me, how do I calculate the appropriate margin of safety for modern assets like technology companies or innovative businesses that don't fit traditional valuation models? This is precisely the right question, and the answer requires both mathematical rigor and psychological insight. The first principle to understand is that margin of safety isn't a fixed percentage or universal formula. It's a dynamic concept that varies based on 3 key factors: the certainty of your analysis, the stability of the business, and your own psychological temperament. A highly predictable utility company might require a 20% margin of safety, while a rapidly changing technology firm might demand 50% or more. Let me introduce what I call the certainty spectrum framework. On one end, you have businesses with predictable cash flows, durable competitive advantages, and stable industry dynamics, what I've always called defensive investments. These require smaller margins of safety because your estimates of intrinsic value are more reliable. On the other end, you have enterprising investments, businesses facing greater uncertainty, undergoing transformation, or operating in volatile industries. These demand much larger margins of safety. The psychological challenge most investors face is accurately assessing where a business falls on this spectrum. We naturally overestimate our predictive abilities, especially with exciting, innovative companies. The discipline of margin of safety forces humility into this assessment. Now let's discuss specific techniques for calculating margin of safety in contemporary markets. I've adapted my original approaches to account for modern business models while preserving the fundamental principles. Start with what I term the multiple valuation method. Rather than relying on a single valuation approach, calculate intrinsic value using at least 3 different methods: discounted cash flow, earnings power value, and liquidation value. The spread between these valuations provides your first insight into the appropriate margin of safety. A narrow spread suggests higher certainty. A wide spread indicates greater uncertainty, requiring larger margin. For technology and asset-light businesses, pay particular attention to what I call qualitative durability. Does the company have network effects, switching costs, intellectual property barriers? These qualitative factors can justify accepting a somewhat smaller margin of safety, but only if you truly understand them and they're durable. The psychological trap to avoid here is what behavioral economists call narrative fallacies, becoming so captivated by a company's story that you ignore the numbers. The most dangerous investments are those with compelling narratives but inadequate margins of safety. Another crucial adaptation for modern markets involves analyzing management quality. In my era, we could largely rely on financial statements. Today, with the prevalence of stock-based compensation and complex financial engineering, you must assess whether management's interests align with shareholders. This assessment forms part of your margin of safety calculation. I recommend what I call the skin in the game adjustment. If management owns substantial equity and compensates themselves reasonably, you might accept a slightly smaller margin of safety. If their interests appear misaligned, excessive compensation, poor capital allocation history, frequent dilution, you require a larger margin. Now let's address the psychological aspect of actually implementing margin of safety decisions. This is where most theoretical understanding breaks down in practice. The challenge is what I term opportunity cost anxiety, the fear that by insisting on adequate margin of safety, you'll miss wonderful investments. I experienced this profoundly during the technology boom of the late 1990s. While speculators made fortunes in internet stocks, we maintained our discipline and required proper margins of safety. We missed the spectacular gains, but we also avoided the catastrophic losses that followed. The psychological strength required to watch others get rich while you remain disciplined cannot be overstated. This brings me to a critical psychological tool, the margin of safety journal. I want you to maintain a record of every investment decision, specifically documenting your calculated intrinsic value, the margin of safety you required, the actual price you paid, and most importantly, the reasoning behind your margin decision. Over time, this journal will reveal your personal tendencies, whether you're consistently too optimistic or too conservative, allowing you to calibrate your approach. Another practical technique is what I call the forced error analysis. Before making any investment, write down 3 specific ways you could be wrong about the business. Not vague risks, but precise, fundamental errors in your thesis. Then calculate whether your margin of safety adequately protects against these potential errors. This exercise forces intellectual honesty into your process. Let's discuss how margin of safety applies to different asset classes in modern portfolios. Many investors make the mistake of applying equity-style margin calculations to all investments, but different assets require different approaches. For bonds and fixed income, margin of safety primarily involves analyzing the issuer's ability to pay throughout economic cycles. The key question isn't just whether they can pay today, but whether they can pay during recessions, interest rate shocks, and industry downturns. For real estate, margin of safety involves both the property's fundamental value and the durability of its income streams. I pay particular attention to location durability. Will this location remain desirable in 10, 20, 30 years? For private businesses and venture investments, margin of safety requires even more conservative approaches given the lack of liquidity and transparency. Here, I often apply what I call the liquidity discount factor, requiring additional margin to compensate for the inability to exit quickly. The common thread across all asset classes is that margin of safety must account for both quantitative factors, financial metrics, and qualitative factors, business durability, management quality, industry dynamics. The psychological discipline lies in not letting excitement about qualitative factors override quantitative requirements. Now, I want to address a sophisticated concept: how margin of safety changes with market cycles. During euphoric bull markets, adequate margins of safety become nearly impossible to find. During pessimistic bear markets, enormous margins of safety abound. The psychological challenge is having the courage to act when margins are ample, and the discipline to wait when they're scarce. This brings us to what I term the margin of safety clock. Imagine a clock face where 12 o'clock represents peak market euphoria, minimal margins available, and 6 o'clock represents maximum market pessimism, abundant margins available. Your investment activity should correlate with this clock, aggressive when margins are plentiful, cautious when they're scarce. The psychological innovation here is decoupling your investment activity from market momentum. Most investors do the opposite, buying aggressively when markets are rising and margins shrinking, and selling when markets are falling and margins expanding. The margin of safety framework helps reverse this destructive pattern. In our next session, I'll share advanced techniques for identifying margin of safety opportunities in seemingly efficient markets, including how to find hidden assets, assess catalyst credibility, and structure investments with multiple layers of protection. We'll also explore how the greatest investors of our time, including my most famous student, applied these principles to build fortunes. Remember, margin of safety isn't just a calculation you perform before buying, it's a continuous assessment throughout your ownership period. As business fundamentals change, as markets fluctuate, as new information emerges, you must constantly reevaluate whether your margin of safety remains adequate. This ongoing discipline is what separates the true value investor from the mere bargain hunter. The most beautiful aspect of this approach is that it provides both financial protection and psychological comfort. Knowing you've built adequate margins of safety allows you to withstand market volatility without panic, to view price declines as potential opportunities rather than threats, and to make rational decisions when others are ruled by emotion. This psychological stability is perhaps the greatest dividend that margin of safety pays.